please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
You're with us here on a fresh new edition of Trading Hour. It's a Thursday morning. I'm Prashant Nair. With me is my colleague Surabhi Upadhyay. Well, the markets are not doing very much. We're down about 20, 21 odd points or so. And this is in line with expectations that maybe there's a bit of a pause coming after this breathless rally that we've had now for the last many days and many weeks, actually. The good thing is this pause is happening even at a time when, global markets are not really pausing. I mean, look at what happened overnight on the US side. I mean, S&P crossed 2,900 for the first time. Asia is not doing all that badly. Rupee is at where it is. So, and then you got a flat kind of a day here. So nothing really to take away in terms of insights or anything of that sort from what you're seeing right now on the screen, except the fact that it's a bit of a pause which is coming in. There is flash at the bottom of the screen. This is gas price hikes, which is effective from the September 1st, and this should be positive for ONGC, etc. I was reading that gas prices over the last 5 cycles. I mean, the last 5 times when revisions happened, gas prices actually were cut. And now after 5 straight declines, you've got a hike which is actually coming through. So in that sense, is positive, and prices are, and ONGC is actually moving up a little bit, 2.5%. We'll actually, what we should do is we should try and put the ONGC management on the phone line and ask them what kind of impact do they see because of that. Of course, there are users of gas, and that's another story. So, good morning.
Good morning, Prashant. Well, yeah, this doesn't come as a surprise because we are in a regimented regime. Every 6 months, gas prices are revised in this country. And the formula is also well defined. It's a combination of Henry Hub and a couple of the other major gas trading hubs around the world. And you take an average, and that's how the formula is arrived at. International prices have been moving higher, and therefore the blended rate here in India is also going to go up. ONGC is definitely a beneficiary. The one aspect of trade that stands out today, a bit of a sore point for the bulls, is that the financials are once again, the financial sector is sitting out of today's trading action. So most of your bank stocks are sulking quite a bit. Whether it's Yes Bank, where there's obviously a separate overhang that continues on the stock. Let's pull up Yes. It's down 4%, by the way, for the week as the market awaits clarity on Mr. Rana Kapoor's extension. But even others, State Bank of India, ICICI Bank, generally speaking, the banking universe isn't doing too well, and the Nifty Bank is struggling with about a 160-point card. So that's one facet of trade that we have to take on board. Well, what to do in such a scenario? What kind of trades can you work with? That's exactly the question that we have for Sudarshan Sukhani. Morning, Sudarshan. Good to have you on the show as always. Very quiet on the Nifty. Banks underperforming a little bit. First of all, any trade on the indices, and then we'll talk stocks.
Yes, actually, Surabhi, there is a trade on the index. That is on the Nifty. We were looking for a buy on dips opportunity, and this is a perfect buy on dips opportunity for the index, for the NSE, for the Nifty, not for the Nifty Bank. So at this point, we should be looking to buy the index, buy the Nifty, not for today. Because today is FNO expiry, it's very difficult to say how markets will behave and what kind of movements will happen because of the rollover and so many other things. But we want to buy the Nifty for tomorrow or Monday. I think by Monday, there will be significant gains in any purchase done now. So there is a clear trade in Nifty and a very clear avoid in the Nifty Bank, which is underperforming. Individual stocks will keep on offering opportunities. I am taking mainly the long side of this market, mainly because the trend is very clearly up. What we are simply getting is a minor dip. So Wockhardt is a buying opportunity, again part of the pharma sector which I have been upbeat on for a long time now. So consider buying Wockhardt, consider buying Dabur. FMCG is doing well today, and for all we know this this good effect could continue for not only today but tomorrow also. And finally, by ACC, there was a small mild decline in ACC yesterday and day before, and that represents a buying opportunity. So buy the Nifty, buy individual stocks, stay on the long side. Use this dip as an opportunity.
Okay, Sudarshan, thanks very much for coming in with that perspective on trading ideas, etc. Well, we revert to the flash at the bottom of the screen. This is essentially sources to CNBC Awaaz, and let's bring in our colleague from CNBC Awaaz, Neeraj Bajpai, who's joining in with the story that gas prices are set to go higher. starting the 1st of September. Neeraj, morning.
Good morning. My sources confirm that natural gas prices will be raised up to $3.5 per MMBTU, and that because of the currency depreciation and as well as the hike in the natural gas prices in the international market. Now it's $2.86 per MMBTU in the international market, so that in India it is also increased. Last revision was in March. That time it was up by 6% and it was 2.86. Now it is 3.5, maybe 3.4 to $3.5 per MMBTU. Why? Because there is currency appreciation and also the oil price hike. Every 6 months it is revised. The 1st September it will be implemented, and tomorrow evening it will be launched. Earlier it was March when it was raised 6% natural gas prices. And the majorly impact will be on ONGC, Oil India, and little bit in Reliance Industries.
Okay, Neeraj, thank you very much for getting us that update. That's really helping the ONGC stock for sure. Shouldn't be much of a problem for the likes of IGL or MGL, because this is sort of raw material for them, so it's a straight pass-through. That's what we've seen in the past. By the way, when LNG prices are up almost 60-70%, I mean, Asian rates are up 60-70% in the last 6 months to 7 months alone. So there's a major international surge that's also coming in, and the currency factor, as Neeraj explained. Okay, let's move on, get you some more trading ideas going. This time on the F&O side of the market, we have Shubham Agrawal joining in from Co-op Securities. Shubham, thanks for being with us. What are your bets?
Good morning, Surbhi. So the first bet will actually be on Bank Nifty, and there are some interesting data points to observe. So first of all, when the market is overall headed upward, whenever there is a pullback, there is a good opportunity to accumulate some of the indices like these. But if you look at the next week option open interest, 28,000 put has the highest OI in the put option, and the current price of Bank Nifty is around 28,050. So I think it's a very good opportunity to accumulate Bank Nifty, not from today's expiry perspective, but certainly from the next week expiry perspective. So with that view, I recommend to take a bull call spread, which is a limited loss strategy, and the trade would be to buy a 28,200 call option for the 6th September expiry and sell a 28,500 call option. The net spread right now is 80 rupees. The target for the same would be 200, and the stop loss will be at 20. The second strategy is on a stock, that's Ashok Leyland, and 135 is a very strong resistance for Ashok Leyland. And even on the option data, we can see that the call highest open interest has been around that area, and the stock has been facing stiff resistance around that level. So we expect a pullback to happen. So we recommend to buy a 125 put option for the next monthly expiry, that is 27 September. The target for the same would be 7 rupees, and the stop loss has to be kept at 1 rupees. And lastly, a long call on NIT Tech, which has already seen a consolidation. And we feel that with a personal perspective, there should be a good up move in NIT Tech. So 1400 call option for 27 September expiry can be bought. The target for the same would be 50, and a stop loss has to be kept at 18.
Okay, thanks very much. We will speak again with you for more market updates. Sonal is standing by with what is the impact on ONGC because of this gas price hike that we are seeing. Sonal, what are you picking up?
Well, Prashant, it is definitely a positive for these upstream companies, say ONGC and Oil India, and we are seeing that in the stock prices currently. So, well, a 15% increase in the natural gas price would flow to the top line and the bottom line. So, currently, ONGC is producing close to 65 MMSC MD of oil every day, and that production levels are increasing on a quarter-on-quarter basis. So, definitely that will be impacting positively on their revenues and profits. However, for Oil India, it is not that big a positive, because the analysts are saying that on a daily basis they produce around 7.3 MMSC MD of oil, and that production levels are declining on a quarter-on-quarter basis. So these two stocks will be in focus. Additionally, we'll also look at city gas distribution companies, because their raw material will be natural gas. However, again, a marginal negative for the companies, because they see a pass-through. They are basically able to pass through these hikes in raw materials to their customers. The bigger worry for these companies will be the depreciating rupee, because a lot of imports are done by these companies. So these are certain things that will be impacting these stocks. Back to you.
Okay, Sonal. Sonal meant gas, not oil. We should update the graphics as well over there. Again, just to repeat the number, it's 65 MMSCMD of gas every day. That's ONGC's production level. So that's the kind of benefit that they can obviously look forward to with this price revision that's come through. Thanks, Sonal, for that. We'll take a very quick break on that note. By the way, we should also pull up, as we take this break, some of the tile-making stocks. Gas is a feedstock for a couple of the tile companies, obviously. So because of the higher cost of that feedstock, there's some pressure on the likes of Somani and Kajaria at this point in time. So, Mark, the picture is still pretty much the same. Flattish on the indices, 20 down on the Nifty at this point in time. Guess which stock is on the move once again? BHEL. Again, we're looking at a 1.5% increase coming through. So that's one stock on the move. The market's just so hopeful about the prospects of a buyback, and maybe that's exactly what's firing up the stock once again this morning. So that's one name perhaps that you can spot. And also let's keep an eye out on JSPL. Some of these metal stocks are still very, very active today. JSPL is one of them. But right now, let's get into our next conversation. Madhav Dar, managing partner at GTI Capital Group, is with us. Madhav, good morning. Thanks for joining us on Trading Hour. So it's been quite a journey for the market, right? We are looking at fresh all-time highs. We are talking about almost 40,000 on the grand old index. But there are still some nerves out there in the broader market, you know. Just your sense on the rally, whether you think the worst of the mid-cap correction is over and whether you think we're actually good to build from here.
I guess, yeah, a couple of points. Firstly, you know, it's obviously, I mean, I hate to sort of de-Indianize it, but the S&P hit all-time highs and everything else is getting dragged along with it. So the most important factor remains the U.S. Fed and the U.S. stock market, and particularly tech, and the narrowing of the global cycle in terms of leadership. The same thing is happening in India, and as you said, the mid-caps took a big correction and a big beating. Hard to say when it's all over. I mean, obviously, a lot of damage has been done, and they're sort of picking up a little bit, but you're still about 80% above the long-term average trend of the mid-caps. So it's still expensive and still extended. So it's hard to say exactly what will happen there. But the Indian cycle continues. I mean, the good thing about India is that it's starting to accelerate in the last year. And so even though there may be some global dampeners in terms of the Fed hiking, the US bull market being very old and extended, the Indian economy is finally starting to pick up and accelerate, and there is some movement on bad loans, and there's some progress there. So it bodes well for an investment cycle picking up and for us in India to have a longer cycle. So it's a mixed bag, but it's broadly encouraging. Having said that, if and when a US correction, broadly encouraging. Having said that, if and when a US correction hits, it'll take everything down with it.
Mm-hmm. Madhav, hi, morning, Prashant here. So then what is the right way to sort of looking at everything together? I mean, so keep a wary eye on the US market, etc. By the way, you know, I was reading a Credit Suisse a note yesterday which said that US market valuations from a year ago have actually gotten cheaper because earnings estimates for the S&P 500, for example, have gone higher. So, is that, I mean, how do you, I mean, put all of it together and tell us what's the right way to look at things?
No, listen, you know, I think, you know, I'm very boring as far as TV is concerned, as you know, in the sense that I think the stock market is not a trade and it's not a stunt. It's a long-term commitment to the idea that you need to be broadly assigned with the growth assets. And there are fewer clear growth assets I see in the world than US equities and Indian equities, frankly. And I'm not saying this because I'm Indian. I'm saying this because the structural underpinnings of long-term growth in India seem extremely solid to me, despite the hiccups we have. So how do you invest in something like that? You invest in never selling. That's how you invest. And every time there is a big hiccup, you buy more if you can. Honestly, that's the way to do it. It's very hard to second-guess stops. It's much easier to pick bottoms, and you should try and do that. And the reason it is because fear is instantaneous and more extreme, and greed is slow and cumulative. So market tops are very hard to stop. Market bottoms are much easier to stop. So if you have a structural long-term trend and you're doing one of these, every time it looks bad, you should buy more. That's the way to do it, and not get out of what is a multi-year trend. And there's very little doubt, Prashant, I know I've sounded boring, I've been saying this for decades, and I find India the same way, that there will be periods where there is stress in the system, and the high to low correction may be 20%. By the time you sell and buy back, you're going to miss half of it anyway. So this doesn't bode well for brokers or breaking news, but that's the way to do it. And the point I'm making, which is more of an intellectual one and not an action point, is yes, we are late in the game. Yes, valuations are extended even though earnings are rising both in India and the US. You're 10 years into a bull market in the US. The economy is extended. The Fed is starting to raise rates. Leadership is narrowing. And those tend to be late cycle, that's a late cycle phenomena. So there's little doubt in my mind that we're in a late cycle phenomena. Whether it lasts another 6 months, another year and a half, there will be a recession and the markets will correct sometime in the 18 months. And there's sort of little doubt in my mind. The question is, do you anticipate that? Do you act ahead of it? I'm not sure yet. You may go into a blow-off in these tech stocks, sort of like you had in 2000. Sort of like you had in 2008 early. So if it becomes visible that something is going truly crazy, you can take some action.
Okay, Madhav, allow me to intervene because you made some very, very interesting points there. Do you think that this could be perhaps building into a 2000-like situation as far as US tech goes? And I mean, you're saying that you're convinced that 18 months down the line, we're looking at a recession. So even in India, is this a late-stage rally then? Then would you not be looking at buying what's already run up? And in India, we know what runs up. Private sector banks will run up. Consumer stocks will run up. So then, how do you play this?
Yeah, no, you're asking a very important and very difficult question. And yes, I think you're probably right. I think you don't necessarily want to chase that. But what happens in late stage is what is working becomes a momentum trade. I mean, like you're seeing it in the US, that you narrowed to broad tech, then you narrowed to big tech like FANGs, and last night you had a big move in the market and only Amazon was up in the US. So yes, I think that what has worked, which is high quality private sector banks, or are at very expensive valuations, you know, tech, banking, credit in general has done fantastically. Everybody knows that's the big secular growth story in India, which I happen to believe, but it's done extremely well, everything from HDFC to Bajaj Finance and so on. And by temperament, I tend not to chase those things, but it's hard to say, because when you go into a blow-off, the things that are already extended get more extended. It's not the rational thing that happens, it's the momentum trade that happens. So yes, I think it's possible that you go ballistic, that you go vertical, and it's too early to short or too early to get too skeptical about these things, because the broad underpinnings of investment psychology and earnings momentum, which are not to be sneezed at, are very solid, very solid.
Okay, so Madhav,
so I think it runs longer.
It runs longer. I mean, if you were to put money on it, how much longer before? You know, 10%. These regular corrections are fine. I mean, you know, when they come, well, everybody starts to panic, and it'll be no different the next time as well. But the one that I'm talking about is a big one. You know, we've not had a big one since 2008. So, how far is that, according to you? I mean, you don't see a big one.
I don't see a big one. No, no.
That is reassuring.
I think 2008 was so devastating. Big ones will only happen if economies completely unhinge. So I see the US economy correcting, the Fed, but the unhinge has already happened. I mean, even though we've come so far, I mean, don't forget that from the S&P from 2000 peak only surpassed its peak, you know, a few years ago. So for 12 years you were sidelining, although it didn't look like that because we went straight down and straight up. So no, I don't see a big one at all. I mean, I think the world is in a much more solid place, and frankly in a desynchronized place, in the sense that Europe is still flagging, the US is overheating, India is starting to pick up, China is starting to slow down. So for the world in aggregate, that's sort of a healthy thing. although your country picking and stock picking becomes more important, but systemically, the world is a safer place where cycles are desynchronized.
All right, Madhav, thanks very much. It's a pleasure, and appreciate you joining in with that perspective on the markets. As always, Madhav Dhar, not boring at all, I might add, and very clearly saying that he doesn't foresee at least a really big one. Let's put it that way. We take a very quick break here. We come back, we discuss market market technicals. Ashwini should be with us. And before that, we also get in a quick commodity perspective. Manisha Gupta, she'll be joined by Jonathan Barat, CIO of Probus Securities. So that conversation follows right up.